Today I'll show you a simple but powerful range breakout strategy similar to the previous one, or orb opening range breakout. Is just applied on a different range of time, and you can apply that on every type of asset. For today, I'm going to show you the breakout strategy applied to gold and dollar yen, and then I'll use Quant analyzer to build a portfolio and see how diversification improved the results. Okay, this is the M15 gold chart. The strategy is very simple. You mark a range of time. In this case, this is an indicator of Asian session, London session, and then New York session is not marked up. For example, this is the Asian range, and then if the price break through, that's an entry. If the price break below, that's an entry. In this case, I'm not going to use exactly the Asian range, but the time range is inside the Asian session. That's the EA, and this is the visual mode. We are on the 5-minute chart. That's a visual backtest. That was the first trade. This one was the range start, and that was the range end. So when the range finish, and then after the range finish, you have a high and a low. If the price break above the high and then also close above, because that's another filter I add. The same thing for the short. In this case, we have to wait 6 minutes. 6 minutes close above, and then we can trade, so we can open the position. This case was a win, and the position closed exactly here. Why? So this is at 1855, a forced close. I use this forced close, as I show you on the last video, to prevent and avoid swap fees overnight. It's working very well, because I will show you the backtest from 2018 till now. Even with this type of closure, it's working well. So let's see another trade. You can see the range. That's the high, that's low. Maybe it's gonna change a little bit more. Oh, okay, perfect. So that's the perfect condition where my filter improved the strategy, because for a simple breakthrough strategy, that was an entry point. But with my filter, we're not gonna go in with the simple touch of the line. So in this case, we didn't open any trade before 1855, so no trade for the day. It's very simple. And then let's see another trade. This one, unfortunately, was kind of break even, but that's the risk management, because with this trading stop loss, sometimes you're gonna reduce profit, like in this case, because without a trading stop, our position, it could be closed up here, but not in this case. So no problem. After 7.5 years, my backtest show that the trading stop is actually much better. Also to improve the Sharpe ratio and win rate. Now I'm going to show you the backtest without the visual mode, because it's not useful now. The equity line is kind of good. Of course, it has the drawdown, but overall, after 7.5 years, it's a very good equity line. And the good factor are recovery factor. Of course, this is 11, but is on 1 minute open, high, low, close. And that's kind of fake number, because it changed a little when you switch to Realtix data. My Realtix data report is going to be a little less, around 9, but still very good. These things mean that you could have a 17 drawdown for 187% profit over 7.5 years. And that's nice because you could think about, let's say, S&P or NASDAQ, where you had the same performance, maybe a little bit less for the S&P, but of course with 3 times the drawdown. And that's applied only on one asset. Now I'll show you on Quant Analyzer how to improve your performance, your yearly performance, let's say monthly, etc., just applying the same concept, the same strategy on different assets. Now I'm going to show you on USD JPY, dollar yen, and just with 2 assets, this strategy is going to improve. Here we have the gold equity chart, the one you saw before, and then this one is for USD JPY. And on Quant Analyzer, we can build a portfolio like this. That's perfect. The blue line is going to be the aggregate equity line. So if you see, this one is the gold equity line, and this one is the USD JPY equity line. Maybe it's better if I show you just the sub equities only. In some period, if you had just one algo on one asset, you could see some period of drawdown, like here, and then like here again, and here. But what happened if you applied the same strategy with more assets and more strategies with different conditions, uncorrelated? But even just 2 is going to improve a lot the performance over the years. Like in this case, of course, USD JPY and gold are not correlated, and you can easily see it here, because when the gold is not performing well, USD JPY is performing well. There are many factors that can influence the asset, but we're not looking at those. We're just applying the same concept to different asset class. That's it. That's the portfolio. If you see, the aggregate equity line is much more stable. On the overview here, you are going to see a higher return on drawdown ratio, like the recovery factor from 9 that we saw on gold, and on USD JPY actually it was like around 11. We see here 17.15. That's much better with kind of the same drawdown, because on USD JPY we had a bigger drawdown, like 2K. I didn't put exactly the same risk on those in this case, but you could do that. Yeah, that's it. And Quant Analyzer is very powerful because you can analyze your portfolio and your algorithms in a simple way. From here, you can check and see many other factors, many more data, like stagnation days. That's 170. That's high. So it means that for 170 days, we saw stagnation on the equity. So like period where price didn't make anything, like this period here, okay? Didn't make any gain. The more assets and algos you have on your portfolio, the better it's going to be. So I'm gonna show you the last thing here. Okay, recompute stats. Here are the yearly average return. With that account size, you could have made 54% a year. That's good. Those are the performance over the years. 2018, we saw a very low profit year on 2023. The more algo you have, the better it's going to be. That's the basic concept. And you can see it from the, okay, that's the portfolio correlation. We have only 2. It's not that useful now, but when you have maybe, let's say, 10 algorithms or maybe 20, it's going to be much better. I'm going to show you this on the next video, maybe the one later. I have portfolio actually with around 12 algorithms, and the situation is much different. The return on total ratio is around 40. Last thing is Monte Carlo simulation. Let's say with 100 simulation, randomize. Okay. This one. Okay, that's the chart. So the Monte Carlo simulation is just to showing you the possibilities that you could have in the future, not only with this type of strategy or portfolio, but with any type of portfolio. The blue line here in the middle is the one we actually backtest. So that's the equity line of my portfolio with those data. But the Monte Carlo simulation, what it does is gonna take all of the different trades and mix them, like 4,000 trades, and mix the profit and loss, not modifying them only on the daily time frame, but also like weekly and monthly. What that means is going to mix all of those data randomly. That's it. And if you mix those data, you will see this outlier, very good outlier, but then after like the first 500 trades, it made like 14,000. Maybe you'll see the same here. So with a lower performance overall. And that's just to show you how confident you could be. Here, there is a high probability that the max drawdown is going to be 4,000 USD. It's like 50%. It's just to be more realistic. And that's it for this video. Like and subscribe.